Beneath the daily fluctuations of exchange volume, the network is supported by a heavy foundation that operates independently of market sentiment. By mid-June 2026, market anxiety is high. Short-term speculators are bracing for a deeper correction driven by the recent downward trend. This is the Clark-Moody Bitcoin dashboard from June 16th, capturing network data at block 953,961. The mempool shows that transactions are clearing steadily. The minimum fee rate is holding at exactly 2 satoshis per vbyte. The blockchain is operating at baseline efficiency. This stability suggests that the current market fear is not reflected in the network's technical performance. To find the source of the volatility, we have to look past the base layer and analyze the leveraged positioning within the derivatives market. This BTC liquidation heat map reveals a dense concentration of short liquidations stacked immediately above the current spot price. That bright horizontal band represents $83.26 million in short positions resting on the $65,000 line. This creates a probability delta. When liquidity pools this heavily in a narrow range, it creates a scenario where institutional buyers can profit by driving price into that concentrated risk. While the market is heavily shorting the current price, the foundational metrics of the network suggest it is more resilient than the price action indicates. To see how this setup developed, we can trace the accumulation of positions starting on June 17th. On this heat map, we see the initial spot price bleed as it drops from the mid-$66,000 range. The sell-off continues through the 18th, with price moving down through the $64,000 and $63,000 zones. Instead of buying at a discount, traders shorted the move, betting downward momentum would continue. This left the area below devoid of liquidity, with no significant leverage positions to pull the price lower. Meanwhile, yellow bands formed above, marking accumulated new short positions. By June 21st, short leverage peaked. Over $83 million in liquidations were now concentrated in a single overhead band. Highly concentrated leverage often acts as a liquidity magnet. The market tends to move toward these areas to clear the order books. On June 23rd, a final drop to $62,000 occurred, leaving those short sellers holding their positions at the local bottom. This downward movement was driven primarily by derivative activity, moving the price away from the steady metrics seen on the network. To test if the bearish outlook is supported by the network's physical infrastructure, we return to the mining data. Hash rate provides an independent way to verify if the network's macroeconomic health is actually declining. The dashboard shows that the 90-day hash rate is currently holding near 1 zettahash. Specifically, the rate is 960.6 exahashes per second. This indicates that network security is at an all-time high. Because hash rate is peaking while the price is dropping, it suggests that miners are not capitulating or turning off their machines. Miners are currently maintaining profitability. Rather than selling their holdings into a weak market, they are continuing to secure the network. The difficulty epoch shows the protocol is adjusting to this high computational power without evidence of systemic stress. The data shows structural integrity. The entities with the highest capital expenditure in the industry are not reacting to bearish sentiment in the derivatives market. We can also examine the cost of transacting on the network to see if block space demand is reacting to the market volatility. The mempool shows the network is uncongested, providing a low-friction environment. Transactions process steadily at 7.2 per second. Fee estimates remain at 2 satoshis per vbyte, showing no urgent competition. Average fees represent just 0.83% of the block reward. This environment allows institutional players to move significant amounts of capital without paying a premium or alerting the broader market. Whales can execute large spot purchases during this window without incurring significant on-chain slippage. Large-scale spot buys in this quiet environment can provide the necessary upward pressure to move the price toward the concentrated short positions above. Because the mempool is clear, it costs institutional players very little to begin the process of triggering the short liquidations at $65,000. Combining these two datasets reveals a significant asymmetry in the market setup for the week ahead. We have a high hash rate baseline supporting the network, contrasted against $83 million in overleveraged short positions. The current short positions appear overextended when compared to the steady performance of the base layer. The risk is skewed. Downside movement is limited by miner profitability, while the upside has the potential for a rapid move as shorts are forced to cover. If the price begins to recover, the mechanics of a short squeeze would likely accelerate the move toward the overhead liquidity. The $65,000 liquidity band is the primary area of interest for price discovery, as the market structure favors a move toward that concentrated leverage. The on-chain data suggests that the bearish outlook in the derivatives market is not supported by the network's current fundamentals. This underscores the importance of looking at on-chain signals rather than relying on the sentiment found in highly leveraged trading environments. The blockchain provides an objective view of the network's health. With the network fundamentals holding steady, the $65,000 liquidation cluster represents the most likely target for the next major price movement.